Stocks pulled back last week. Expectations are high heading into earnings, and the Fed may not be done yet. Here's what actually matters right now. Hello, I'm Eric Pettway, Chief Investment Officer at Journey Advisor Group. Welcome to CIO Corner. Last week, equity markets moved lower. The S&P 500 fell 2.8%, and the NASDAQ 100 dropped 4.5%. Even with that pullback, the S&P 500 is still up about 8% for 2026. Developed international markets outperformed again last week and continue to lead U.S. equities year to date. On the commodity side, oil and gas prices have come down from recent highs, although the ceasefire situation remains inconsistent day to day. As we close out the second quarter, expectations for earnings are elevated. According to FactSet, S&P 500 earnings are expected to grow 23.1% year over year. If that holds, it would mark the second straight quarter with growth above 20% for the index. This sets a high bar for companies heading into earnings season. This week's focus is the Federal Reserve and why it matters for investors. At its June meeting, the Fed held rates steady in a range of 3.5% to 3.75%. That is down from a peak above 5% after cuts through late 2024 and 2025. Earlier this year, markets expected continued rate cuts. That has now shifted completely, with expectations turning towards a possible rate hike by December. The Fed's latest projections also took a more cautious tone. Growth was revised down to 2.2% for 2026, while inflation measured by PCE was revised up to 3.6%, still well above the Fed's 2% target. The media outlook now points to one potential rate hike before year end, although holding steady is still possible if inflation improves. Fed Chair Kevin Warsh is also signaling a more reform-focused approach. The Fed significantly shortened its policy statement and removed forward-looking guidance about future meetings. He has also introduced internal reviews of the Fed's communication strategy, balance sheet, data sources, productivity measures, and inflation framework. For context, the Fed's balance sheet currently sits around $6.7 trillion, down from roughly $9 trillion during the pandemic. One interesting note, Warsh did not submit projections in this report, as he does not favor the form of communication. Still, the Fed operates largely by consensus, so his views are likely reflected in the broader outlook. The bigger picture is that the Fed is trying to balance a still healthy economy with ongoing inflation pressures, including the impact of energy prices tied to the conflict with Iran. Oil prices have been declining recently, and further improvement could occur if key supply routes like the Strait of Hormuz reopen. That said, it takes time for those changes to show up in inflation data. Now it's time for Chart of the Week. This week's chart shows the path of the federal funds rate over time. It helps put today's rate environment into context and shows how policy cycles evolve. While short-term Fed decisions can create market volatility, strong long-term investors are typically better served by staying disciplined and focused on their goals rather than reacting to each policy shift. Thanks for spending a few minutes with us today. If you find this helpful, follow us on LinkedIn or your preferred platform. If you have questions about your portfolio or want to revisit your strategy, connect with your Journey Advisory Group team. As always, remain calm, stay focused, and most importantly, stay the course.